Is the stock market in a bear market rally? Or did we just start a new bull market in late December? This seems to be one of the biggest questions on investors' minds right now. It may be too early to tell, but this week gave us a better picture with earnings reports from some big players. Perhaps more importantly, the fragile equity markets forced Fed Chair Jerome Powell to pledge this week that the U.S. central bank will be patient with future interest rate hikes. And if need be, I believe the Fed will likely expand the balance sheet. So quantitative easing is the unnamed other policy tool Powell referenced in case lowering the Fed funds rate proves not to be enough to strengthen the economy and the markets. So let's take a look. Oh, and no, I didn't spell breadth wrong. You'll see what I mean in a moment. This chart here shows the breadth thrust indicator. This indicator was developed by Martin Zweig. It occurs when, over any 10-day period, the number of advancing stocks on the NYSE outnumbers declining stocks by an average of at least 2 to 1. It happened during the first 2 weeks of the recent market rally and often signals the start of a potential new bull market. The signal has happened only 10 other times since 1960. 3 months later, the S&P 500 has rallied as much as 12%. 6 months later, as much as 18%. And a year later, as much as 25%. Thus, even though the current market may be viewed as overbought, the thrust indicator tends to be a blast-off signal, leading to much higher prices down the road. So pay attention to this. Let's go to the next chart. So this chart here is the 1-year daily chart on the SPY, which is a proxy for the S&P 500. Now, if you watched my videos last week on Friday and Saturday, we were in this area here where I thought things were topping out and we were going to possibly head down this week or next week. Well, with the news from the Fed Chair Powell, with the possible accommodation by the Fed, that blew me out of the water. So perhaps we have a new game here. So the market's holding up pretty well since late December, especially considering the lowered guidance by many companies such as Intel, Apple, Samsung, Macy's, Caterpillar, Whirlpool, and Nvidia. From the close on December 24, 2018 to January 25, 2019, the S&P 500 recovered over half of the decline since it peaked back in September 20th, 2018. So, considering all the negative earnings news and the constant political headlines, the market has digested its recent move well and was consolidating in the range of about 2600 to 2675. But with a recent breakout above 2700, is this a clue that the next big leg will be higher, or will the market retest the December lows? Well, the market's still below its 200 moving average, which is about, say, 2740. And many of the technicians feel that this level is the red light or the green light to determine the market's health. If we do see a breakout above, say, 2675, which we have, the 200-day moving average, again around 2740, will be that next area where the chart might hang up, and it's going to be a resistance level. So we're going to have to watch that closely. For the time being, I'm going to be patient. So for today, that's ChewDog Charts. Thank you.